The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to this episode of FedLife Podcast. I'm your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe & Associates. I am going to begin, as I always do, by saying thank you. Number one, thank you for taking the time to watch or listen. But above all, thank you for your service. Government to the country, to me, to everyone. You do not hear that enough, but you will always hear it here. The other person you're always going to hear is the guru, Ed Zerndorfer. He's back with us once again as part of our ongoing mission to reach, teach, and serve you. If you're a regular, you know, once again, we will follow Ed's FedZone articles. If you're new, be sure to head over to the FedZone, that's fed-zone.com, and pull up the latest article, or as I like to say, Ed takes all your notes in advance for you. So you don't have to worry about it if you're in the car, figuring out how you can write stuff down. It's already there. So today we're going to one that's close to my heart. I know it's close to Ed's heart. And that is the impact of our feds who are making charitable contributions, charitable donations as a result of the One Big Beautiful Bill Act. And that's going to make charitable giving more challenging, which I don't think any bills should do. But again, that's just my opinion, not the opinion of Raymond James Serving Those Who Serve. So Ed, let's start out with the big picture. The OBBBA makes some changes. When do they take effect, and what's the overall impact for our feds who give to charity?
Well, Dan, you mentioned that the One Big Beautiful Bill Act, OBBBA of 2025, there were several provisions in it. Probably two of the major provisions were the charitable contributions and also the state and local tax deduction. Okay, those are two major. Now, actually, both of those provisions will take effect on January the 1st, 2026. There were actually some provisions in the OBBBA that took effect this year. But these two major ones are going to take effect on January 21st, 2026. And I think, well, I got time to worry about it. Well, actually, you do not when it comes to charitable contributions, because there is a lot of planning that has to be done.
Sure.
This issue of charitable contribution giving has gotten more complicated over the past 8 years as a result of the passage of the Tax Cuts and Jobs Act of 2017, which took effect on January 1st, 2018. It was actually supposed to expire as of December 31st, 2025 this year, but as a result of Congress passing OBBBA and the President Trump signing it on July 4th, it will be the tax cut. Many of the provisions in the Tax Cuts and Jobs Act of 2017 are going to be extended at least 5 years.
Gotcha. So with this new law, there actually is a little bit of good news for our folks who don't itemize deductions, right? So tell us about this new $1,000 or $2,000 deduction.
Okay. Let me just go back to the Tax Cuts and Jobs Act of 2000.
Okay, sure.
We'll go back to there just to talk about one of the major provisions to come out of the Tax Cuts and Jobs Act of 2017 is that it doubled the standard deduction. As a result, and Dan, as you know, I have an accounting and tax practice, that most clients I have do not itemize. They take a standard deduction as a result. Now, what is included when it comes to itemized deductions? medical expenses, out-of-pocket medical, dental expenses that have to exceed 7.5% of your adjusted gross income. State and local taxes. That includes income taxes, includes personal property taxes, includes sales taxes and for people who live in states who do not have that income taxes, and also property taxes and income taxes. As a result of the state of the Tax Cuts and Jobs Act of 2017, your state and local tax deduction is limited to $10,000.
Sure.
Now, most people pay more, especially those individuals who live in blue states, like we're talking about California, New York, Maryland, New Jersey, Massachusetts. They have high state and local taxes, and some of these states have high property taxes.
Sure.
One of our sons lives in Long Island, New York. Do I have to say any more? He and his wife work. They pay $12,000 a year in property taxes. They both work. So I will tell you, by February 1st, they've already reached the $10,000 limit.
Sure.
So that was a restriction. Mortgage interest reduction is also included there.
Sure.
But as you know, Dan, mortgage rates came down in 2020, and a lot of people who did refinance their mortgage interest reduction, thank God they have a lower monthly payment, but they don't have that much in mortgage interest. And finally, charitable contributions. So what's the result of this? Most people, Dan, do not itemize. I saw a figure that only 13% of filers actually itemize and take the standard deduction. Now, what is the downside of that? The downside of that is that if you are making charitable contributions, you're not going to get any deduction. You're not going to get any deduction because you're making standard. The rule is that when it comes to itemizers versus standard deductions, that if the amount of your itemized deductions, all the things I listed, is less than the standard deduction, given your filing status, whether it's single, head of household, married filing jointly, married filing separately, if the amount of your itemized deductions is less than the standard deduction, you're better off taking the standard deduction.
Gotcha.
So those individuals who take the standard deduction, who make charitable contributions, are not going to get any tax benefits. Not that should be their motivation. You should I'm just giving my own philosophy now. This is my personal way. You give to charity because that's the thing you should do. Anyhow, so
I agree.
So one of the provisions now coming out of the OBBBA is the fact that next year, starting next year, January 1st, 2026, if you do not itemize, you're allowed to deduct of your you take the standard deduction, and you're able to get a deduction for your charitable contributions up to $1,000 if you file a single, or $2,000 if you file married filing jointly. That's in addition to your standard deduction. Those people who itemize, those individuals who will itemize next year, we're going to talk about that, who make charitable contributions are not going to get that extra $1,000, $2,000 because that is included as part of their charitable contributions on Schedule A. They itemize.
Gotcha. So, Ed, you also point out there's some important limitations to the deductions. Did you just cover those, or there's still more?
Oh, yeah. When it comes to that $1,000, $2,000 deduction, number one, the deduction, the $1,000, $2,000 has to be a cash or check, credit card donation. You're not allowed to include in that $1,000, $2,000 deduction any household goods you may donate to, charities, things like that. It has to be a cash, check, credit card donation. That's number one. And here's the second one. And this one really, really, in my opinion, is going to hurt a lot of people. The $1,000, $2,000 deduction is deducted from your taxable income, not your EGI.
That is a difference.
That is. And why am I saying that's going to hurt some people? Let's take individuals, senior citizens like myself and my wife, who are enrolled in Medicare. Medicare.
I see where you're
Part
going.
A, Medicare
Yep.
Part B. Medicare Part A is free. You've already prepaid the premiums. Medicare Part B, Dan, is not free. You pay a monthly premium based on what? Something called your modified adjusted gross income. Modified is, which for most people is going to be their AGI, your adjusted gross income. So if you're able to deduct things from your AGI, when it comes to certain deductions, certain things, you're maybe able to save some money. And that includes Medicare Part B, because the Medicare Part B premiums, Dan, are based, as I said, on for most people, AGI, and they're what they call income tiers. Income tiers. The higher your AGI, the more you have to pay for Medicare Part B. You'll be subject to what's called IRMAA, an income monthly adjusted amount. Well, somebody who's over 65, like myself and my wife, who do not itemize, that $1,000, in our case, $2,000 deduction is not going to help us pay less for Medicare Part B, because it's being deducted from our taxable income, not our AGI.
Gotcha. Now, Ed, your article, you also talk about some not so good news for people who do itemize. You mentioned there's something called 0.5% of AGI disallowance. Now that just sounds complicated. It sounds like it hurts. Can you break that down for us?
Dan, I would tell you, this thing is so complicated with this OBBBA. I had to study it for almost a day.
I believe it.
I really had to go through it piece by piece to understand it. And as we're going to see here, we're going to be talking about two restrictions when it comes to charitable contributions if they do itemize. The first one is that if you itemize starting next year and your itemized deductions exceed your standard deduction, and you're going to get the full benefit of making cash charitable contributions and or donating charitable goods. There's no restriction on that. But the first restriction is that your total amount that your charitable contributions are going to be limited to 0.005% of your AGI. 0.005%. That's 0.005 of your AGI. So the best way to understand this, Dan, is to do an example. And I have several examples in the column.
You do. And they're great.
Let me go through a couple of these examples.
Yep.
And we have Sally. Now, Sally is single, and she itemized her deduction. During 2026, Sally has an AGI of $150,000. That's her AGI.
Gotcha.
So on her 2026 federal income tax return, Sally cannot deduct 0.5% of $150,000 or $750 of charitable contributions. She's anything above $750, she can deduct. Her floor is $750. So, for example, let's say Sally makes $1,000 of charitable contributions during 2026. How much can she include as part of her charitable contributions? $250, because 1,000 less 750 is 250.
Ouch.
Another example, we have Stephen and Marlene, who are married, filing jointly, and they itemize reductions. Their 2026 AGI is $350,000.
Mm-hmm.
On their 2026 federal income tax return, Stephen and Marlene cannot deduct 0.005% of $350,000 or $1,750. Anything above $1,750, they can deduct. So if Steve and Marlene, let's say, give $2,000 of charitable contributions, that means that $2,000 less $1,750, leaving $250 as part of the charitable contributions.
Ouch.
That's and we haven't gotten to the real killer coming up here.
I know. And Ed, you and I are pretty much on the same page. I always scratch my head because this is the first time something's really been enacted. This has been talked about for years, that of all the things to limit, charitable contributions probably shouldn't be it, but that's another topic for another day. You mentioned there's a killer coming. There's another limitation that affects higher income federal employees. So tell us about the restriction on the folks that could be in the 37% bracket.
This is another one that had my head shaking. Okay. The amount of your itemized deductions are going to be limited if it turns out that an individual or a couple are in a 37% marginal tax bracket. As you know, Dan, the highest federal marginal tax bracket, which was a result of the passage of the Tax Cuts and Jobs Act of 2017 and extended as part of OBBBA, is 37%.
Gotcha.
During 2026, starting in 2026, if one is in a 37% marginal tax bracket, then the amount of their charitable the amount of their itemized deductions, which includes charitable contributions, is only going to be deducted at a 35% rate. In other words, Dan, 2% of their itemized deductions are being thrown away.
Yep.
They're thrown away. So
yeah,
what are you going to be left with here? When all is said and done, is it worth itemizing?
Sure.
When all said and done.
Now, Ed, you also mentioned that people in that highest bracket could lose out on expanded state and local tax deductions. So how much are we talking about there?
Well, on the state, when it comes to the idea is that if you itemize on the federal, then you can itemize on the state. If your itemized deductions are being reduced on the federal and your AGI is higher, it could result in lower state itemized deductions. The only thing I got to say is that as a result of the itemized deductions, being reduced, I'm an accountant, I'm kind of tax person. I tell my clients who live in states that have state and local, who have state and local taxes, that if it turns out that the total amount of your itemized deductions being reduced results in your being much better off taking the standard deduction on the state, find out from your accountant whether you're better off taking the standard deduction on the state, because in many states you're allowed to do that. You're allowed to do that. Okay. You can't go the other way though. You can't take the standard deduction on the federal and then itemize on the state.
Gotcha.
But you can go the other way. That's something that they may want to work on.
This is pretty complex stuff, Ed. So what are your thoughts on what our feds might want to do to maximize their charitable tax benefits before these changes kick in? Is there anything they can do?
Yeah, I think the first thing they got to do is they can't wait till next year. I'm saying that because maybe if they made a lot of charitable contributions this year in 2025 with no restriction, Dan, maybe they should consider pushing in all their charitable contributions into 2025, and itemizing this year, and next year, perhaps maybe they're better off taking the standard deduction because they're going to get an extra standard. They're getting extra standard deduction, especially if you're a senior citizen. The standard deduction again has been doubled. Plus, there's going to be another $6,000, $12,000 standard deduction for individuals over age 65 next year. So that would be a provision. But planning is very important. Family planning is very important. You got to think about, you say, well, I can worry about that later. No, you can't worry about this later. I just want to mention something else about pushing your charitable contributions into 2025. Remember what I said, Dan, about the fact that state and local taxes, that deduction as part of itemized deductions, are limited to $10,000. And if it turns out that even with all your charitable contributions, that the $10,000 together with the $10,000 state level taxes restriction, you might be better off just taking a standard deduction in 2025.
Sure.
Whereas in 2026, what is the state and local tax payments going to go up to? As much as $40,000.
Gotcha.
A big difference, which may make itemizing in 2020, 2026, even with the 2%, shade and the 0.5% floor on charitable, 0.5% of your AGI floor on charitable contributions. So you have those two things on the limitations on charitable contributions. You might be better off taking a standard deduction in 2026. I think it's very important for federal employees to meet with their tax advisors this year. Don't wait till next year. Maybe a good time. And there's always a good idea to meet with your tax advisor in the fall. I tell my clients, I don't like surprises come in the spring when you come to me get your taxes done. Let's get together and talk about things in the fall while it's still, because you might, for example, you may have a tremendous underwithholding. When you hadn't paid enough taxes, estimated taxes, you didn't have enough withheld. We can fix that while we still have time. The other thing I want to mention in terms of charitable contributions, that who may be very helpful to individuals, federal employees, and retirees who are over 70.5. They can make what's called qualified charitable distributions, which come from a traditional IRA. What happens is an individual, and I just did one for myself because we're starting to give our charitable contributions this year, so we're taking it from my traditional IRA, taking money out, in which the charity takes the money. Your IRA custodian takes the money out of your traditional IRA, takes it out, makes out a check to the charity. Now, do I get a charitable contribution? No, I do not. But it's taken off the top of the traditional IRA. And if you've reached your required beginning date, like mine, I'm 74 years old, that will count towards your RMD, which means RMDs are normally taxable. You got to pay full
Absolutely.
tax.
Yep.
You don't have to pay tax on that portion of RMD. So that would be that's what I suggest. You don't have to you have to be 70.5 or older to make a QCD. Okay. And I have a column in the Fed Zone that talks, and it was just updated because now it used the amount that you can make for QCDs has increased tremendously. I think it's up to $105,000. That's per person, and that would be a really a way to save on taxes, especially if you've reached your required beginning date. And all in all, that will reduce your AGI, and so for purposes of Medicare Part B and maybe some other tax deductions that or credits that are sensitive to one's AGI, this could result in a lot of savings.
Sure. And folks, as usual, Ed has some great examples that we haven't even touched on yet within the articles. Head over to the Fed Zone, read the article, or better yet, since podcasts live in a world outside of space and time, pull it up, have it in your hand as you go through it. So, Ed, in some, charitable giving is getting more complicated, but there are still ways to be smart about it, especially for our federal retirees who can use QCDs, right?
Yes. But I just wanted to, they asked I get this question all the time. Can I make a QCD from my TSP account? The answer is no, you cannot. But what you can do, and you're allowed to do this anytime, do a direct rollover of a portion of your TSP to a traditional IRA. And then once the money is in a traditional IRA, you can make a QCD anytime of the year. But word of caution, if you are still working, you're over 70.5, you're still working, and let's say you've reached your required beginning date, and you want to make sure that your QCD meets your RMD. Do your QCD before. That's the first thing in the year you should do before taking your R&D,
Gotcha. Gotcha. Brother, once again, I got to say thanks on behalf of all of our feds. Nobody is putting this kind of effort in to get this kind of detail and get this information out there. These tax changes are coming whether they like it or not, and you're helping our feds prepare. So I still don't know how you keep it all straight, but I'm glad you do. And thank you for that.
My pleasure, Dan. I just want to echo again to everyone listening and for watching, please do not do this on your own. Talk to your tax advisor, like you said earlier today. If you need somebody at Serving Those Who Serve, with an advisor who will point out some of the things you need to know about QCDs and everything, everything. So don't be bashful. You need to. This is not easy stuff. Like I said earlier today, it took me a day to read this tax bill.
I believe you.
And then I put it down, came back the next day before I put stuff on paper.
Gotcha. Well, folks, that's a wrap. We are Serving Those Who Serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify. And please remember, share it with your friends, even a few strangers. Don't forget those live webinars every single week. Just go to swserve.com. You'll see the webinar button. Click it. The whole menu is going to come up. Yes, absolutely. The guru will come to you as we reach, teach, and serve you where you are. Sign up for one, sign up for all, and share that page with your friends. I promise you they will thank you. Be sure to read Ed every single week in the Fed Zone. You can find that at fed-zone.com. Don't miss any. We amplify a couple of them here. That means there's always at least 2 more in there that are dynamite. You don't want to miss them. So, signing off for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, I will say, as I always say, good luck, Godspeed, and above all, remember, it's your Fed life. Please make it a great one because you deserve it. Stay well, everybody. We are out.